Jeff Santoro, there's a stock that you and I we argue back and forth a good bit about in the background, and that's PayPal, a company that you've been relatively optimistic on their turnaround story, and that I have been constantly pushing and pushing you to really explain and to demonstrate that there's a turnaround happening. You've got about 3 reasons that you think PayPal is a buy right now, and you might have convinced me. You ready to talk through it?
Yeah, let's do it. Let's see if I actually convinced you.
Awesome. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. You see it right on the screen. It's over my face. You can't miss it. It's giant. Fool.com/unscripted. You should go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Check it out. Let's talk about this. First thing I want to do, pull up the stock price for PayPal. Wherever you stand on it, this is the thing you probably follow the most. It's either scared you away or drawn you into the company, and that's just the stock price. Over the past 5 years, even on a total return basis, while the market has done very well, PayPal investors have seen the stock fall 38%. And if you go from the peak, from the high periods back during the pandemic, when PayPal and basically every payments company and everything tied to the internet was doing so well, stock is still down a bonkers 81%. So down for a couple reasons. Part of the reason it's down is everything's down from those highs, those exuberant highs. The other part of it too, Jeff, is the reality that, well, PayPal's growth slowed. They've seen some user declines. Their profits have crashed. And there's a lot of questions about if the momentum that they lost, if they're really going to be able to turn the business around, deliver the kind of growth investors are expecting. What's the story?
Well, just to piggyback on what you just said, if you go back even further, it's losing to the S&P 500 total returns going back even to since it came on the public markets. You're losing to the market. So yeah, it is
when it was spun out of eBay.
Well, and so I'm glad you mentioned eBay, because I think that's part of the story too. If you just think about the last 5-6 years, it's gone through the pandemic, all the highs and lows of that. It has dealt with the eBay stuff for a long time. It's only very recently that they stopped even having to report qualifiers in their earnings about this without eBay and this with eBay. That's finally in the past. So that, I think, is also tied to the company was a little bit unfocused for the past couple years. They've had a CEO transition. That's the new person's finally in place for about 4 months now. And first they were a payments company, then they wanted to be the everything app, and now they're back to focusing on their core competencies, it feels like. So I think one reason I'm a little bit bullish right now is I'm happy so far with what I'm hearing and seeing from the new CEO. And if he can do the things he's saying he's going to do and starting to show they're doing, I do think that this will bode well for the stock moving forward. But let's look at this most recent quarter, because that's what was reported just last week. So I think the headline number that has people maybe spooked is two things. The first thing that I think has spooked the market a little bit is the guidance. So if you look at the slide that's on the screen here, non-GAAP EPS mid-single digit growth for Q1 and in line with this year for the full year. So the CEO on the earnings call did say that 2024 was going to be a year of transition, and believes that all the things they're putting in place are going to help turn the business around, but it's going to take some time. So I think that's one thing that's gotten people a little bit bummed out about the results. I think the bigger thing is if you look at the headline number for total accounts, if you look at the active accounts here, that's probably the other reason that the market's a little spooked. Active accounts for the full year and for Q4 were actually down year over year by 2%. So at first you might think to yourself, well, that's not good. PayPal needs active accounts and now there's less people on the platform. But there's a little bit more to that story when you dig in. So as you see right below that, monthly active accounts are actually up a little bit. And that's because the accounts they're losing are not important accounts to the business. They're churning off low engaged users in developing markets, not their core business. And this isn't exactly in line with where they've been trying to go for the past several quarters, which is to focus less on growth and more on monetizing and catering to their high engaged
engagement,
users.
right?
Right. Engagement.
Yeah.
Even though the headline number is that accounts are down, when you really dig in, it's at the worst, not bad news. And at the best, it actually might be good news because what they're keeping is of higher quality. And then just to stay on this slide for a few more seconds, if you look down to the next two metrics here, number of payment transactions up double digits, transactions per active account also up double digits. And these are not outlier results. If you go back several quarters, I know this isn't the most visually appealing slide in the world. They've been in this
right here.
Yeah, they've been in this double digit range for a while now. So despite all the craziness with the stock and active accounts slowing, the engagement piece has been growing steadily this whole time. So I'm not as worried about maybe the headline numbers as maybe the financial media is making them out to be.
That's the thing that catches the eye when the total number of users on any of these big platforms goes down. Of course, that's going to lead. I do think there's two parts of it that are right. I think you're right that focusing on its most engaged users is important, and not putting resource towards maybe markets that aren't delivering the kind of returns or expectations at this point that they want makes sense. But I do think in the long-term interest of the business, management does need to be careful and not be walking away from markets that might be really important in 5 or 10 years, right? So there's certainly a balance there that I think is important that the company has to manage.
Oh, I agree. And I don't think the goal is to have active accounts continue to decline. And I would imagine at some point they want to see them reaccelerate. But I understand the desire to take some time, take a pause, focus on efficiency in the business, focus on profitability, focus on cash generation, and then maybe hit the gas pedal again when it comes to user growth, when maybe it's more appropriate to do so.
Reason one, the engagement story, the user story is probably better than you think. I'm fair. I think you've answered that one. What's next?
So there's some profitability and cash generation stuff here that I think is important to keep an eye on too. I believe in 2023 they generated around $4 billion in free cash flow. They're expecting in 2024 to have $5 billion in free cash flow. So you're going to see that accelerate. And they want to spend 70 to 80% of that money rebuying shares. And that would continue a trend that they've already started. Over the past 5 years, I believe, they've reduced their share count by almost 10%.
Yeah,
So
and this is a longer term trend. They've been buying back shares just about since they were spun out of PayPal, right?
yes,
They're
the
seeing
pace
out
is
of
just,
eBay.
I think the
Yeah.
pace has just picked up a little bit
Oh,
more
you can
on the,
see clearly over the
right.
past couple of years, it's absolutely accelerated.
So they're planning to keep doing that. And sometimes, I don't know, when you see the stock fall so much and investors start to get worried, to me, it helps to step back. This is still a profitable business that generates a lot of cash and has a lot of cash on the balance sheet. That gives a decent margin of safety in my mind for an investor, that they have some time to figure this out. If they were verging on unprofitable or had negative cash generation, I think there'd be a lot more reason for worry. So the second thing for me is a capital allocation plan that is helping and rewarding shareholders, and increased cash generation, which is tied to running the business more efficiently. It's tied to why the company is profitable. So bottom line cash, I think that's a good story too.
When businesses get to the scale of a PayPal, I think you're right. It's important that management be mindful about how they allocate capital. We've seen with these weaker markets where they've attempted to enter those markets and haven't necessarily generated meaningful return. Pulling back investments that aren't generating a return makes sense. And when your stock is undervalued and you have a lot of cash and you're a cash generative business, buying back stock is a great way to generate return on a per share basis. So they've committed, Jeff, I believe it's a $5 billion, the number they've penciled, at least $5 billion towards share repurchases in 2024. With a market cap of roughly $60 billion, that gives every investor that holds their shares about 8% more PayPal without buying a single extra share. That is substantial value creation for long-term investors. So there's two pretty good reasons. Number one, the customer engagement story is probably better than what you think. Number two, management's doing a really good job with allocating capital to generate returns for shareholders. What's the third reason?
The third reason is I think the stock's cheap, right? I could be wrong about some of this, or the turnaround story could take a little bit longer than maybe even I'm expecting. But if you look at either price to earnings or price to sales, it trades right now for just about the cheapest it's ever traded since it IPO'd. So in my mind, for a company that is growing its free cash flow, for a company that is profitable, for a company that is rebuying shares, for a company that has two of the most well-known peer-to-peer payments platforms in PayPal and Venmo, and slowing revenue growth, but not declining revenue. It's not negative revenue growth or anything like that. All-time lows for valuation, I think gives you a little bit of a margin of safety here in case it takes longer to play out. This is no longer a growth company, at least not at the moment, and at least not on the top line, but it's also not being valued like one. So to me, I think the third reason to consider buying it is simply that it's not that expensive right now.
Yeah, and I think that makes sense. And the order that we've discussed these in, I think, is really important, because if you're looking at valuation, the best way to fall into a value trap is buying a stock just because it's cheap, right, Jeff? And I think you've made a pretty solid case. That's not the case with what's going on with PayPal. The quality of the business is there. The engagement's probably better than expected. They're still growing engagement with their most engaged users. Again, the revenue growth, you look at these numbers, total payment volume, low single digits, revenue growth, high single digits last year, expecting pretty similar revenue growth next year. Great economic returns, creating per share value with that cash flow for investors. You put all of those things together, and then you can say, okay, well, we also have some margin of safety with the valuation. I think it makes sense. No promises that I'm going to buy the stock, Jeff, but anybody that's interested in PayPal, don't take it from me, take it from Jeff Santoro. There's 3 pretty good reasons why maybe it's a better buy right now than you might have thought.